Today, we're cutting through the noise and really diving deep into the architecture of market timing. If you spent any time at all in technical analysis, you know the simple moving average, the SMA, is foundational.
It is. It's the first tool everyone uses to kind of smooth out price data.
But the SMA has this one massive, almost trend-killing weakness: lag.
It does. It has a huge lag problem. It treats yesterday's data the exact same as last month's data. And, well, in fast-moving markets, that means you're perpetually late to the party.
Right. So our mission today is to take the source material and really unlock the enhanced precision of advanced moving averages.
Exactly.
We want to move past the basics to identify trends faster, to optimize entry and exit points with, greater accuracy, and truly master risk management.
The goal really is simple. It's to tackle the latency, that delay that just plagues standard moving averages.
Because that delay is the enemy of profit.
It really is. These advanced MAs they're like mathematical engineering, designed specifically to prioritize the present. They manipulate the weighting of the data to give you a clearer, faster signal on trend direction.
So we're looking for improved responsiveness, fundamentally.
That's it.
Okay, so let's unpack this then. What are the primary tools detailed in the sources, and how exactly do they manage this delicate balance between speed and smoothing?
Well, the foundational concept is that these advanced MAs go beyond the basic math of the SMA.
Okay.
They do it by either assigning a much heavier weight to recent price action or, and this is interesting, by combining multiple calculations to sort of mathematically cancel out that inherent delay.
Which means they react to today's news and volatility much faster than an average that treats data from 3 weeks ago with, equal importance.
Precisely. And if we look at the 4 core types that are discussed in the sources, the first and probably the most widely known upgrade is the exponential moving average, the EMA.
The EMA. Right. I've heard it called the gateway drug to advanced trading.
It is, and it's popular for a good reason.
So tell us about that difference. Why exponential? What does that really mean?
It's all in the math. Instead of a linear weighting like the SMA, it uses what's called exponential decay.
Okay, so think of it like a memory that fades really quickly.
That's a perfect analogy. The most recent price data carries the greatest weight, and the influence of older data just drops off very, very rapidly.
So the current price really dominates the calculation.
It does, and this feature makes it the top choice for capturing short-term trends or reversals much more quickly than its simple counterpart.
Got it. So if you're a short-term trend hunter, the EMA is your go-to tool, your speed dial.
For sure.
Now, let's talk about the next step up. The weighted moving average, the WMA. If the EMA is so effective at weighting recent data, what problem does the WMA solve that the EMA doesn't?
That's a really critical distinction for a trader to understand. While the EMA uses that exponential decay we talked about, the WMA assigns weight linearly, systematically. For example, in a 10-period WMA, today's price is weighted 10 times, yesterday's 9 times, the day before 8 times, and so on. It's a step decrease.
I see. So it's systematic rather than geometrically decreasing. What's the practical implication of using that linear approach?
Well, this linear structure can actually help smooth out certain types of high-frequency market noise a bit better than an EMA, which can sometimes overreact to a sudden spike because its weighting is so aggressively front-loaded.
So a WMA is useful for smoothing out moderate volatility while still reflecting clear recent price movements.
You got it.
Okay, now let's talk complexity and speed. This is where the engineering gets deep. The whole moving average, or HMA. The source material suggests this thing is designed specifically to tackle lag head-on.
Oh, it is. What's fascinating here is that the HMA is specifically engineered to not only smooth the data even further, but to drastically reduce the lag. It does this with a complex calculation involving 2 weighted moving averages and the square root of the look-back period.
So it's an attempt to create a moving average that's both responsive and smooth.
Exactly. It provides a much purer, less delayed representation of the trend.
It sounds like we're trading some calculation complexity for that speed, though. If pure, unadulterated speed is the ultimate goal, where does that lead us?
That leads you to the double exponential moving average, the DEMA.
The DEMA.
Yeah, and the name pretty much tells you how it's achieved. It's calculated by applying one EMA to the data and then applying a second EMA to the result of the first one.
So it's a recursive technique that tries to mathematically negate the lag from that initial calculation.
Yes. It's designed for the quickest response time mentioned in the sources. It allows traders to react almost instantaneously to really rapid price changes.
So it minimizes the delay even further than a standard EMA, making it the tool of choice in, say, extremely short-term, high-velocity trading where every millisecond counts.
That's where you'd use it.
That's a great map of the tools themselves, but, as always, it's not just about the tool, it's how you use it. So let's look at the key application strategies detailed in the sources, starting with the classic and most popular method.
That would have to be the moving average crossover.
Right.
This strategy is fundamental. A crossover happens when a faster, short-term moving average crosses either above or below a slower, long-term one.
And the short one represents current momentum, while the long one is the underlying trend.
Precisely.
And the sources cite a very specific, very popular combination for these crossovers, the 50-day and the 200-day EMAs.
That's the canonical pairing, yeah. They capture that medium-term and long-term momentum so well. And when you pair those two, you generate the two most famous signals in all of technical analysis.
The first being the golden cross.
The golden cross. This is when the 50-day EMA crosses above the 200-day EMA. It signals a powerful, sustained bullish trend.
But isn't the golden cross often, well, too late? Given these are lagging indicators, what does the source say about the countersignal, the death cross? Is that actually actionable?
That's an excellent question. The death cross, the 50-day crossing below the 200-day, is a strong warning sign. But you're right, it's retrospective.
So its value isn't necessarily for jumping into a short trade right away.
Not always. Its real value is for confirming that the long-term bullish structure has broken down. It tells you, the trader, to liquidate your long positions or at least to tighten your stop losses dramatically because the dominant trend is failing.
Okay, that makes sense. Now, these advanced MAs also do something else. They move from being just signal generators to playing a crucial role in managing risk.
Yes, by creating dynamic support and resistance levels.
And this is one of their most powerful uses.
It really is. A key EMA, and the 200-day EMA is often cited as the gold standard here. It doesn't just sit still, it moves with the market. In an uptrend, as prices pull back, they often find support right at that 200-day line.
Okay, so practically speaking, how does that dynamic level help a trader manage their risk?
It defines your risk very clearly. Traders often look to enter trades when prices pull back to this dynamic support level.
Right.
And then they place their stop losses safely just beyond that moving average. If the price breaks through that 200-day line, the whole assumption that the uptrend is intact is invalidated.
And you get out with a predefined minimal loss.
Exactly. It's an elegant marriage of entry optimization and capital preservation.
Another key strategy you see involves tackling market noise. That challenge of figuring out what's a real trend reversal and what's just temporary, meaningless volatility.
The market is full of that noise, isn't it? Confusing short-term spikes and drops.
So how do you decide if a two-day dip is the start of a bear market or just a buying opportunity?
This is where the superior smoothing power of the WMAs and the HMAs really comes into play.
And why are they better for noise cancellation than, say, a standard EMA or SMA?
Because the HMA in particular is so aggressively focused on trend purity, it just filters out those chaotic spikes and drops that would cause an EMA to twitch erratically.
So if you're a trend follower in a notoriously choppy, volatile asset,
then the WMA or HMA helps you keep your eye on the main highway. You ignore the side roads and avoid getting faked out by false signals.
got it. And finally, there's the trend trading approach, using multiple layered EMAs.
Right. That strategy is all about using exponential moving averages in combination to confirm the market's direction more quickly. It's like triangulation.
Okay.
A trader might use a short EMA, say a 20-day, to capture momentum, a mid-range 50-day for confirmation, and the long 200-day for the overall structural context.
And the signal for an entry comes much earlier in that case.
Much earlier. It comes when that shorter 20-day EMA crosses above the longer 50-day EMA.
Okay, here's where it gets really interesting for me. These advanced tools, they offer clear advantages, especially in responsiveness and smoothing. But they're not flawless. We need to be critical about the challenges.
Of course, and we can summarize the benefits pretty quickly. You get improved responsiveness because they weight recent data so heavily.
Right.
You get effective smoothing of volatility, thanks to methods like the WMA and HMA. And you get enhanced trend identification by using those layered combinations to filter out the noise.
But the sources also highlight the critical challenges. And the first one is the big one we've already mentioned. MAs are lagging indicators.
That is the immutable law of moving averages. You're always trading based on yesterday's data. But the second major challenge, the one that can devastate a trading account, is the whipsaw.
A whipsaw. What causes that, and how do we spot the warning signs?
Whipsaws happen almost exclusively in sideways or range-bound markets. When a price is just bouncing between tight support and resistance lines, the moving averages just lose all their predictive power. They cross back and forth over and over.
So you get a buy signal, you enter.
The MA crosses back down, you exit for a loss, and the cycle just repeats endlessly.
It's the market equivalent of a snake eating its own tail, just generating false signals left and right.
It is. The key takeaway has to be that MAs are purely trend-following tools. If the market is not trending, you should not be actively trading based on MA crossovers, period.
And that leads to the final warning, the risk of overfitting.
Yes.
This is a common behavioral trap, isn't it? Trying to find the perfect settings.
It's so common. Overfitting happens when a trader spends way too much time optimizing their MA periods, trying to find that, a 19-day EMA and a 53-day EMA worked perfectly for the last 6 months of historical data.
They end up fitting the strategy to the noise and specific quirks of the past, not to general market behavior.
Precisely. And then the market changes its behavior, as it always does, and that perfectly tuned strategy just fails instantly in real time.
The parameters have to be chosen based on generally accepted market cycles, not on curve-fitting historical data.
Right, like the 50-day and 200-day we discussed.
Okay, that brings all the technical detail into perspective. To make this really concrete, let's look at the specific case study in the source material. It's about a trader named David in the S&P 500 index.
This case study perfectly illustrates the layering of these strategies.
So where did he start?
David's goal was not to scalp for tiny profits, but to capture a major index trend with maximum risk efficiency. So, step 1, tool selection. He chose that multi-layered approach we just talked about, using the 20-day, 50-day, and 200-day EMAs.
Because of their superior responsiveness, he's layering signals short, medium, and long term. So how did he pull the trigger on the entry?
Step 2, entry confirmation. He was patient. First, he saw the 20-day EMA cross above the 50-day EMA. That was his early sign of momentum.
But he did jump in there.
No. Crucially, she waited for confirmation. He waited until the 50-day EMA then crossed above the 200-day EMA, officially forming that highly reliable golden cross. That was his final signal to enter a long position.
And he didn't just walk away. He used the MAs for active risk management while the trade was open.
Absolutely. Step 3, proactive risk management. As the market rose, David used the 50-day EMA as his active dynamic support level. So when the price rallied and then pulled back toward that 50-day line, he saw it as a healthy correction, not a reversal, and he strategically added to his position.
And the stop loss. That has to be tied to a major structural level, right?
It was. His safety net, his stop loss, was placed safely below the 200-day EMA. He was essentially telling the market, if the long-term trend fails, I'm out of this trade entirely. It defined his maximum risk before he even got in.
That is a highly structured system. So what was the signal that told him it was time to exit?
Step 4, the exit signal. Well, the trend eventually started to slow down, which led to that short-term momentum failing. His exit signal was when the quickest MA, the 20-day EMA, crossed back below the 50-day EMA.
So that signaled the end of the short-term uptrend.
It did. He exited his entire position right then, locking in his profits before the market had a chance to fully reverse and eat away at his gains.
So what does this all mean then? I mean, the case study demonstrates the entire process. Initial identification, using the shorter EMAs, confirming it with the golden cross, and then proactive risk management, using dynamic support and stop losses tied to those reliable long-term MAs.
It's a complete system built around responsiveness and, importantly, discipline.
So in conclusion,
advanced moving averages provide traders with a more refined and robust structure for identifying trends, filtering out that market noise, and managing risk proactively. Whether you're using the lag-killing HMA or the speedy DEMA, success really depends on understanding the subtle differences between them and, crucially, avoiding those choppy, range-bound markets where false signals are so common.
the source emphasizes that even the most advanced indicator remains fundamentally a lagging indicator. It's based on what already happened. So given this inherent delay, what combination of leading indicators, I'm thinking maybe volatility metrics or order flow analysis, what would you research next to pair with these MAs to try and anticipate those tricky trend changes before the moving average finally signals them?
And on that crucial note, we have to reiterate the foundational warning that's embedded in all the source material. Trading financial instruments involves significant risk of capital loss. Market volatility can result in rapid value fluctuations, and you may lose more than your initial investment.
This deep dive is purely educational. It is not financial advice.
Please consult a licensed financial advisor before making any investment decisions.